Welcome to Self-Invested. My name's Lemuel and today I'm going to be talking about why you should invest your money with a stocks and shares ISA instead of just saving your money in a normal banking account. So I'm going to start off this video by talking about what a cash ISA is. A cash ISA is similar to a normal bank account, but the difference is it protects the money you have saved away from tax. Everyone has a personal allowance of £1,000, which means the first £1,000 of interest you gain on your money in a savings account is usually protected from tax, but any money over that £1,000 is taxed at your normal income tax rate. However, in a cash ISA, your money is protected completely from tax, so any interest you earn, even over £1,000, doesn't get taxed. So I can give an example to illustrate this point. Say you had £75,000 saved in a bank account with an interest rate of 2%, you would have gained £1,500 in interest. In a normal bank account, £1,000 of that money would be tax-free, but the £500 would be subject to tax. If you're a basic rate taxpayer, that's 20%. That means 20% of that £500 would be taxed, leaving you with only £400. However, if that money was in a cash ISA, you would keep all £1,500 instead of only £1,400. The only problem with a cash ISA is that the interest rates that are going are quite low. 2%, for example, is actually quite high in this current climate because the Bank of England's interest rates are very low. The problem with that is that your money is likely to lose value over time the longer you keep it in the bank account because of inflation, which is the rate at which prices rise. For example, if you put £100 in a bank account with an interest rate of 2% 10 years ago, today that would be worth £122. However, according to the Bank of England, inflation has been 3.1% over that same period, which is more than 2%. And so £100 10 years ago is now equivalent to £136. In real terms, the buying power of your money is actually fallen by 10% because you've kept it in a bank account with a lower interest rate than inflation. So this is where the benefits of a stocks and shares ISA come in, because it allows you to invest in financial assets that can gain greater interest than you can from a normal bank account. For example, if you had invested that £100 10 years ago in an index fund that tracks the S&P 500, which is an index of the 500 largest companies in the US, your money would have grown by 11% on average year on year. That means you would have ended up with £288, which means the buying power of the £100 you put in 10 years ago is more than doubled. In that example, you can see the benefits of actually investing your money rather than just having it in a savings account. Before I go any further, I've got to make clear, growth in your investment is not guaranteed. When you invest your money, you are putting your money at risk, and there's no guarantee that your money is going to grow. This is because you'll be investing in the stock market, which is very volatile. It goes up and down, and there's no guarantee that when you pull your money out, that it'll be worth more than when you had invested it. So if it's so risky, why should you invest your money? Well, this is because in the short term, although there may be a lot of volatility in the stock market, over time, the value of the market tends to increase. So the longer you hold your investment, the more likely you are to see growth. Now, I've got a few examples to illustrate this point. If you had invested £100 on the 1st of January 2018 and then tried to take that money out in December 2018, your money would have actually fallen in value to £94. That means your money would have dropped 6% in value. And that's just the fall in the value of your investment. In addition to that, inflation grew in that period by 2%. So in terms of the real value, the buying power of your money, that £100 that you invested in January would have fallen to £92. That means that the buying power had fallen by 8% by December 2018. However, if you had invested £100 over a 5-year period up until December 2018, your money would have grown by an annualized interest rate of 6.31%. This means by December 2018, that £100 you put in 5 years ago would have grown to £136. If you adjust this for inflation, the value of your investment would have grown by 26%. This means if you went to the grocery store, you'd be able to buy 26% more fruit and veg than you would have 5 years ago. If you'd invested your money for a 10-year period between January 2009 and December 2018, your money would have grown by 10.75% to £278. If you adjust that for inflation, your money would have grown to £232. That's an increase of 132%. That means the buying power of the £100 you put in 10 years ago had more than doubled by the time you took it out in December 2018. Now, the reason that's so high is because you would have been investing during the subprime mortgage crisis, when the price of shares and the price of stocks on the stock market was very low, which is an example of why it's a good time to invest when the stock market is falling, not to run away and not invest. So if you'd invested your £100 over a 20-year period between January 1999 and December 2018, your money would have grown to £208, which is an annualized interest rate of 3.63%. If you adjust this for inflation, your money would have grown to £133. The reason why your investment is lower than with the example of the 10-year investment is because you would have been investing during the dot-com bubble, when the share prices in the market were overpriced, and so you would have been buying at a very high price before the market collapsed. But you also see in that example, even though you bought at a high price over time, your investment still beat inflation, which is an example of why it makes sense to keep your money in investments over a long period and not just to invest for the short period. So if you'd invested £100 over a 25-year period between January 1994 and December 2018, that £100 would have grown to £537, which is equal to an annualized interest rate of 6.96%. In real terms, adjusted for inflation, your money would have grown by 212%, which means your investment would have tripled the buying power it had when you invested it 25 years ago. So finally, if you'd have invested £100 during each period in the examples I just gave, so £500 in total, your investment would have grown to £1,250, which is equal to an annualized rate of 6.4%. If you adjust this for inflation, the £500 that you'd invested would have grown to £895, almost doubling the value of your investment. The examples I've given don't even include the returns you get from dividends, which if you had reinvested would have increased your interest rate significantly. So now you know why you should invest. I'm going to talk a bit about what to invest in. I think investing in index funds is probably the cheapest and least risky option for most people. This is because an index fund usually tracks an index such as the S&P 500 instead of tries to beat it. And with an index fund, you actually earn a share of the market rather than a share of an individual stock or an individual company, which is more risky, because if that company goes bust, that means you lose your investment. However, if you own a share of the market, so a share of all the different stocks in that market, it's a lot less risky. So now you know why you should invest your money with a stocks and shares ISA and what you should probably invest your money in. My last topic is going to be where you can open a stocks and shares ISA. So there are many platforms available for different types of investors. So the Money Saving Expert website lists a number of different platforms and compares some of the different features and prices of those platforms. There are mainly two different types of platforms. One type of platform does all the hard work for you. It does this by asking you a number of questions about your investment goals and your appetite for risks, and then makes decisions about where to invest your money based on the information you give them. Examples of this type of platform are Nutmeg and Weathify. However, the problem with these types of platforms is that the fees tend to be high because of the advice and the help that they're giving you. The second type of platform is known as Do It Yourself or Do It With Me. Now, examples of this type of platform are AJ Bell and Vanguard. Now with these platforms, they have lower fees, but they don't give you a lot of guidance. They can help you narrow down some options, but the decision about where your money is invested is down to you. And for that reason, the fees are quite low. So tell me, what did you think of that video? Was everything that I explained clear? Was there anything that you wanted more detail on? Let me know down in the comments and I'll either make a video or just respond directly to your comments. Also, please don't forget to like, share and subscribe. Take care.